One of the things that we need to know as a mindful investor is that not every single piece of news is a shocking, massive bombshell. It just represents one data point out there. We don't just look at this one piece of news and go all in on it. We need the ability to connect a couple of data points to make up a story, right? The more data points, the better. As we talked about in the previous video, last week could be huge for Palantir's future. And we're going to go back on that slide. So here's the iPad, right? We have a series of 4 different earnings, all within the same week. These companies, 3M, Fujitsu, Amazon, and IBM, are all recent partners of Palantir, but actually missed a 5th company. And this company is quite critical as well. This company reported on the 26th and is BP, British Petroleum. And why is this so important? As you can see in this article, it shows that the Times reported BP began working with Palantir in 2014. Here's a quote from the CTO. They want to get their data in the right shape so they can reduce the waste inside the systems. And then it says the value of BP's Palantir stake played a significant role in the recent earnings announcement. Another interesting fact right here is that BP actually extended their deal with Palantir for another 5 years. This article was dated back in February of 2021. So this extension is huge because if things aren't working with Palantir and they aren't delivering, why would they possibly extend for another 5 years? This is a great case study. And now we'll take a quick look at the first quarterly results for 2021. The first statement right here packs a lot of information. It says that the strong business performance this quarter has enabled us to meet our $35 billion net debt target early and move to a phase of share buybacks. Okay, so if we break down this statement into 3 different parts. First part, strong business performance. That means the top line is increasing. And then the second part of decreasing the net debt. The third part is share buybacks. So all 3 of these points means that they're flush with cash, as we see with these 2 key numbers. $2.6 billion in replacement cost profit and $6.1 billion in operating cash flow. But then this doesn't really mean much, right? We need to compare these metrics to what happened in the last years, right? So if we scroll down, we see that the profit was $4.7 billion as compared to $1.4 billion for the last quarter. That's an increase of 3-fold. 3x. We're not even talking in percentages. We're talking about 3 times the profit. And then this underlying replacement cost profit is $2.6 billion as compared to $0.1 billion for the previous quarter. That's an increase of 26 times. One of the key culprits is higher refining margins. Okay, now we're talking profit margins. And there's a simple calculation for profit margins, right? So if we switch back to the iPad right here, we have the simple equation of profits equals revenue minus expense. And the objective to increase the profits is to increase the revenue and decrease the expense, right? This should be where Palantir's AI and ML comes in, the artificial intelligence and machine learning. One of the core operations of any petroleum company is to drill oil rigs, right? And there's an art to drilling. When we have a huge field, we don't just randomly poke holes in it just to see if there's any oil. We need to do a lot of research based on the material type, the landscaping, and there's just so many factors. For example, let's say we draw this piece of land right here. With the oil hidden in the ground, that looks something like this, let's say. If we just Google how much it costs to drill these oil rigs, it ranges from $20 million to as high as $1 billion. So the point of where we drill is critical. If we drill over here, that's completely useless. That's like $1 billion down the drain. If we drill somewhere over here, we just get everything on top of this level. This level that goes straight across, we only get this much on top. So the optimized spot would be somewhere over here where we drill to the bottom of this oil supply. And then we can get everything above. If we can get this precision time and time again, aren't we just increasing the revenue by drilling the max oil and also reduce the expense of drilling unnecessary holes, therefore driving up the profits? This is just an assumption of what Palantir can do, but realistically, maybe that is what they're doing. I mean, after all, BP did sign that extension for 5 years, right? From this BP case study, it shows a couple of common themes across the 5 companies that reported last week. Theme number 1 is that the companies has increased their cash flow or profits. Number 2 is that these companies have increased their share buybacks or dividends, or maybe sometimes both. And number 3 is the growth in the cloud sector. And to show that, we're going to go to Amazon. Hit the like and subscribe if you enjoy this Palantir content. It'll greatly help the channel. Thank you. Amazon's AWS. It says that Amazon's cloud division has reported a 32% revenue growth. And this is a faster pace than what the analysts expected, from a 28% growth in the last quarter. So that's another 10%. And this line is the most interesting to me. The operating margin widened to 30.8% from 28% in the prior quarter. Back to the margins, right? Increasing revenues, decreasing expenses. And this is where Palantir came in with the partnership. What we need to know about the cloud business is that it's all about supply and demand. One of AWS's largest clients is Netflix. And Netflix right here, it shows that they're paying $9.6 million per month on AWS. And this number will just keep growing as Netflix continues to grow as well, right? So we kind of already know what the top line is, $10 million per month just from Netflix. But we need to find ways to reduce the cost, the expenses, right? And this is where Palantir comes in my opinion. All the AI and machine learning will know about customers' watching habits, like when the prime times are, maybe around 7 to 11 p.m. So during that time, they'll allocate more resources. But during the midnights, they'll shut off so many of the cloud servers to save costs. But how would we possibly do that with more data points, right? In this recent article back in February in 2021, it shows that Netflix has a total of 204 million subscribers. 204 million subscribers watching habits. How can any team possibly go through all these metrics? We have to resort to the AI and machine learning, right? It's just not humanly possible anymore. Even if it was, it's just a waste of money. Why not develop the best software, the best AI and machine learning to just take care of all these data tables? And what we need to know is that all this is very dynamic. Like if a new show comes out next month, and then suddenly people's watch time on Netflix will just hike up. Not just from that one show, it'll just have that waterfall effect to watch like all the other shows, where they kind of binge on these old shows just because they rebuilt that habit of watching Netflix. So all of this is dynamic, and the only way to cater for this demand is through software companies like Palantir, in my opinion. Okay, so Amazon's cloud growth is there. Now that we confirm AWS's growth, we'll look back on the other partnership for IBM. What we see here is that Amazon reported revenue growth after 4 straight quarters of declines. As we mentioned in the previous video, this is the swoosh effect. And that is amazing. We don't know when Palantir partnered with them. It could be any of these points, but it doesn't matter. All we know is that Palantir enters somewhere around here. And afterwards, we have this growth. This is a turnaround story of a lifetime. When we scroll down to these earnings charts, I'm just paying attention to these cloud metrics. So whenever we see like 18% cloud revenue growth, or this cloud and cognitive software growth of 34% year to year, we're happy with all these growth because we know Palantir has a hand in it. For global business services, cloud revenue growth 28% year on year. These are all great news. So we'll keep an eye on these metrics for the next quarters to see if they're sustainable, because Palantir just entered the bloodstream and it'll take time to see how everything evolves and if IBM is willing to award new contracts for Palantir. Okay, so far it's 3 for 3. All of these company earnings show significant growth, but this fourth company in my opinion is the most critical. Let's take a look at why. Right here for the report, fiscal year 2020, that ended March 31st, 2021. Right here is the most astounding number to me. We see that the revenue has decreased over the past year by 6.9%. But the profit for the year has increased 33.2%. How does that work? So we did less business, but yet we're more profitable? It's not making any sense. If we go back to this equation, we show that the revenue went down, the profits went up. So the last factor is the expense field right here, right? This expense number has to go down so much more than this revenue number to make the profits go up. For example, if the profits went up $100, revenue went down $100, this expense has to go down $200 for all of this to make any sense. And that in my mind is where Palantir came in, to add efficiency to their ERP. And what is the ERP? Here, this is the ERP. The inventory, financials, HR, production, service, purchasing, MRP. It's pretty much every department of the company. What Palantir can do is possibly shave off 1% or 2% off every single one of these departments and we'll end up profitable. But for some companies, we can't possibly increase the revenue. What we can do is just reduce the cost, which means we're just driving up the profitability. One example we can use is for McDonald's. As we all know, one of the best selling items like McDonald's is the burgers, right? So let's say normally the buns cost 20 cents and somehow Palantir can save them 1 cent. 1 cent landed for every single burger, either through the logistics, the making of it, or the ingredients. If the combination of all three can save them 1 cent per burger from 20 to 19, it'll make McDonald's $20 million more. Because ultimately they sell 2.3 billion burgers a year. So shaving that 1 cent here and there will matter because of how big the scale is, right? That's the same for Fujitsu. If we just shave off 1% off every department, we're just making that much more. We can relay that across any company out there, really. So that's a quick recap of the earnings, and the common theme of saving money and adding to the growth applies to all these companies. There's a huge caveat here is that I'm bullish on the company, so all of this can be a confirmation bias. And all this growth and savings has nothing to do with Palantir, and it's just how the world is printing all this money, so all these companies are growing. That could be the case, but even then, why are they choosing Palantir over all the other companies? Like, they have to add some value, right? In order for all these guys to sign these contracts and renew them, that is the key. Because everything is kind of proven, therefore I renew your services. If it's not proven, we're not going to waste any time. Why would the biggest cloud company in the world work with Palantir if they don't see any value that Palantir brings on board? It just doesn't make any sense. Like, they have the smartest guys there, they have Jeff Bezos, they have unlimited amounts of money to hire the best out there. Why outsource to Palantir? That's a question we need to ask. So that's my 2 cents. Drop me a like and subscribe if you found any value in the video. As always, thanks for watching, take care, and I'll see you in the next one.